Welcome to episode 19 of The Rent Roll. Thank you for keeping us in the Apple Top 150 or so investing podcasts. Grateful for all your listenership, viewership, and we're going to keep this thing going every week and try to keep it growing. So today, we got a fun one. I think it's always fun, but I'm a nerd for these things. It's about demographics. And I have got the guy who literally wrote the book on housing demographics, Chris Porter, with John Burns Research and Consulting. He and John wrote a book about 10 years ago on housing demographics, and he's really the guy. And so we're going to dive in with Chris about migration, population, incomes, household sizes, preferences, and how those trends are impacting today's apartment and SFR markets and what they might tell us about the outlook as well. So that's going to be a fun conversation. I'll tell you, we talk a lot about the economy and jobs and other things, and those are obviously important. But I'd argue that from a long-term demand driver perspective, that demographics are just as, or if not even more important than what's happening in the economy at any given time. So at least in a typical economy. So this is important, and it really helps paint the picture for the long-term outlook for the rental housing market, both SFR and apartments. So we'll get into some of that. Before we talk with Chris, I will lay out some of the recent data that we've seen, kind of set the groundwork a little bit, and then bring in the guru to dive into what these data points mean for the market today and for the road ahead. So that's going to be a fun conversation. First, a big shout out to our sponsor, Madera Residential. Check them out at maderaresidential.com. And here's a chart. A bunch of charts, actually. I'm going to start off with one on population growth in 2024. We got some fresh data from the U.S. Census. They have not yet released the metro level data for MSAs, but we do have the newest population data for 2024 on states. So here's what we see. Nationally, we added about 3.3 million people in 2024. And nearly 1/3 of them came to one of two states, Texas or Florida. Both of those states added, Texas added about 563,000 people. Florida added about 467,000 people. And that was twice as much as the next highest state. Two that you might not expect to see in the top five were actually California and New York. And may associate them with more losers than gainers in this stat, but they actually did see the top track the top five, largely more due to immigration than to births or domestic migration. North Carolina ranked between them at number 4, and then South Carolina at number 7 on the total number, but also actually much higher for percentage growth at 1.7%, just below Texas. So good things happening in the Carolinas. Now let's talk about population by age. How old are Americans? And here's a really good chart from my good friend Carl Whitaker at RealPage showing current population by age across the U.S. By the way, this is part of a report that Carl published last summer, and it's a great read if you missed it. It really dives deeply into apartment demographics specifically. And Carl's a great follow on LinkedIn, too, if you don't follow him. Anyway, this chart shows median apartment renter is about 32 years old, 32. That's specifically for market rate professionally managed apartments. That's a few years younger than the median first-time home buyer. And of course, we know that most apartment renters are in their 20s or early to mid-30s. Most single-family renters tend to be a little bit older, depending on the source, usually upper 30s, early 40s. This chart also does a good job kind of painting the picture of where the peak population is. The biggest group of Americans are 32 to 33 years old today. It does drop off slightly after that. It's not dramatic, but it is a slight drop off, meaning that fewer people will turn 32 this year than last year. More people will turn 34 this year than last year. But those shifts are pretty slight. The bigger jump is going to be the boom in 70-somethings as more boomers age up. So I'm going to dive more into that with Chris later on. Let's look more specifically at renters by age. In total, there are about 17 million renter households below the age of 35 today, according to data from John Burns and their analysis of census data. That's the biggest piece of the pie, but it's not just the young adults that matter, of course. As I mentioned earlier, with boomers being so much larger than the silent generation before them, we have a lot more older renters than before, too. Burns data shows about 9 million renter households today that are 65 plus. And in between that, of course, in that core SFR cohort, we have 8.8 million in the 35 to 44-year-old age group and 6.3 million in the 45 to 54 group. And those middle-age cohorts should grow a bit in coming years. Let's drill more into the apartment demographic for a moment, specifically, again, market rate professionally managed apartments. That report I mentioned earlier that RealPage put together with Carl put together for RealPage shows the median age of adult occupants, as I referenced earlier, being sticky at 31 to 32 years old since 2018, even as the national population overall has aged a little faster. So that number could still go up, but that's a really encouraging trend that even as the national population goes up, apartment renters are essentially not aging. So the counterfactor here is that 20-somethings entering the marketplace for the first, or I should say, we have a lot of 20-somethings entering the apartment market for the first time, and that's pulling down the median. And here's a great stat to back that up. Here's a chart that was shared by Eric Finnegan at John Burns Research and Consulting on social media. He's another great follow if you don't already follow him. And it shows that we saw 800,000 young adults between the ages of 25 to 34 leave the nest between 2021 and 2024. Most of those likely ended up in rentals and probably apartments specifically. I'll talk again, this is another topic I'll dive into with Chris later on in today's program, but I think it could be a big driver for the apartment demand that we've seen of late. We saw the share of, if you go back, really the last couple of decades since the great financial crisis, at least, this has been a big theme, the growing number of young adults living at home, and especially through the 2010s decade. But this chart does a good job showing that it's actually been down since 2020, even during the peak inflation period. So we went down from a peak of 18%, now at 16%. That may not seem like a big drop, but it's a lot of people, obviously 800,000 that left to go on their own. And the remaining 16% represents a big chunk of pent-up demand for apartments. And that ties into this next chart, which shows that those young adults living in the nest, they represent a big share of the total kind of renter demand pool out there, more specifically, the growth in the number of U.S. renter households created each year. This is more John Burns data and analyzing census data, and it shows we added more renter households in 2024 than in any year in a long time. Certainly, some of that could trace to fewer people leaving to buy homes, kind of on the how this kind of just fewer people leaving, therefore the net number staying higher, but it doesn't explain those coming into the market. So that's where I think some of this, the factor doesn't get talked about as much. We focus on the lack of home purchases. We don't talk as much about just that, kind of pure traditional formation of traditional renter households. So that's specifically groups like the young adults leaving the nest. They're helping drive that number up. John Burns is projecting renter household formation of nearly 500,000 per year over the next 5 years, assuming normal immigration patterns. And of course, I'll dive more into this later on with Chris as well. But there's obviously a good chance that immigration patterns could decelerate if we see changes in federal policy. And but I think that's primarily going to impact this kind of sub-institutional market a lot more than the institutional market. And that's because recent immigrants are not likely to be moving into an institutional grade class A, B apartments and single family renters that generally cater more to the middle and upper income renter pools. So a lot of REITs and institutional owners will tell you that they just don't see recent immigrants leasing units. So again, I think we're more likely to see an impact, if any, to the shadow market rentals, alternative rentals, shared household situations, basement apartments, all those kind of things. Here's another chart to frame up the outlook for multifamily demographics specifically. So I mentioned earlier that we're going to see flattish numbers in that kind of in population of that core apartment demographic over the next decade as the population ages slightly, but it's not going to be evenly distributed across the country. Here's a 10-year forecast of young adult population growth, ages 20 to 34. And nationally, this is an Oxford Economics data point. They're predicting a slight decline across the country, but some states seeing strong growth. And that list, once again, is dominated by Texas and Florida, as well as other Sunbelt and mountain states, Arizona, Utah, Colorado, North Carolina, Georgia, Tennessee, Oklahoma, and Georgia, South Carolina as well. I think I got all those in there. So in terms of future growth in apartment demographics, these are the states where we could see it. And if we sustain a lower supply environment with the recent plunge in new starts, that could potentially be a meaningful impact in some of these markets. It's less, this table specifically is less important for SFR demographics, particularly as the population ages up. And so we could. So my point here, I guess, is that, well, you always want to kind of follow the people, and as you think about housing, the aging of the population, it creates kind of makes the geographic selection a little bit less important on the SFR side than on the multifamily side. Let's dig a little deeper on the demographic differences of apartment renters versus single-family renters. More data from John Burns. This one shows single-family renters, not surprisingly, are more likely to be married and have kids when compared to multifamily renters. Only about 1 in 5 multifamily renters have kids. And of those, it's going to be a small share that are choosing institutional grade Class A, B apartments. And that's why we very rarely see playgrounds built in apartment communities these days. But we do often see them built in we see a lot of playgrounds in build to rent single family communities. That's just demographics. And so, by the way, every time you have an apartment developer goes to the city council or planning and zoning commission, they say, oh, the PF residents saying, our schools are overcrowded, we don't need more kids in the school. You say, well, apartments aren't really bringing a lot of kids that are school age, especially, kind of Class A apartments that typically get built. All right, a little more on BTR specifically. I talked about BTR a lot last week with our guest, Steve Kimmelman of Redwood Living, America's largest BTR owner and builder. And he talked about demographics in the podcast last week. But this really illustrated, I wish I had this chart then. I should have looked at it previously. It's a John Bird survey of BTR renters. And it shows a pretty even distribution of different life stages, from young singles and couples to young families, mature families, and mature singles / empty nesters. So again, that aligns with what Steve had shared with us as well. A couple other factors that are impacting the rental demand outlook, big picture, both apartments, SFR, BTR, and a lot of it's that so-called delayed adulthood phenomenon. Americans are waiting longer to get married and have kids. Median age of first marriage is now north of 30 for men, north of 28 for women. That's up from in the 1970s, the median age of first marriage was in the early 20s. And even in the 90s and the 2000s, it was mid-20s. And so these numbers just keep trending up. And the same is true of the average age of first-time mothers. Back in 2001, so what's that? It's less than 25 years ago, 24 years ago. The average age for first-time mothers was 25 years old. By 2023, it was 27 and a half. So another 2.5 years. And these are big factors because marriage and children are typically life stage drivers to purchase homes. So that means delayed marriage, delayed childbirth. That's elongating, or I should say, often it's when we delay these life stage factors for various reasons, it's elongating the renter stage of life. So in effect, that translates to more demand for rentals, even if we didn't see any population growth at all. So I think it's obviously a factor I think we're generally aware of, but it's an important one to consider when you think about the kind of renting stage of life and how long that lasts. And of course, higher home prices and mortgage rates certainly contribute to that as well. But these trends were starting well before the rates went up. So again, it's not just a financial decision, of course, it's a life stage and lifestyle decision. All right, so one other thing before we move on, incomes. This is a wildly misunderstood topic, oversimplified topic in rental housing. I've talked about this a lot in past episodes. I've shown this chart in past episodes, so I'm going to keep this part brief, but it is important to think about demographics. When we look at the U.S. renter households overall, affordability is obviously a major headwind. More than half of renters spend more than 30% of income on rent, according to census data. But as I've said a lot, affordability is a bifurcated issue. We have haves and have-nots. And when we drill down specifically to institutional grade, multifamily, and SFR, it's a much, much more favorable story that shows affordability is more of a tailwind than a headwind, particularly with wage growth outpacing rent growth for the past 2 years on the apartment side and pretty close to that on the SFR side. So we're seeing rent-to-income ratios now in the low 20% range across the most heavily traded REITs, SFR and multifamily, as well as in the data reported by RealPage among lease signers on their platform. And good income growth too. We've seen SFR and apartment REITs alike talking about this of late, seeing very good renter income numbers reflecting the fact that institutional apartments and SFR, again, cater those middle and upper income renters. So among apartment households signing new leases, RealPage data here shows substantial income growth over the last few years. And this is kind of a crazy stat to think about, but their data shows that the typical household signing a new lease, this is year ending June 2024, it came in with incomes above $90,000 annualized incomes. Now, of course, that includes roommates, so it could be dual incomes. I mean, you could have two young adults out of college who are sharing an apartment, and they're both making $50,000, $60,000 together. They're a six-figure income household, and so that number is way above the kind of median renter household income numbers for the U.S. overall. So it again reflects the reality that affordability challenges are very real, but they're simply just not concentrated in the places where everyone's looking, ironically enough. So we really need to focus again on the need for more affordable housing, and we've seen the impact as we build more supply. It has an impact, obviously, in the lower end of the market too, but certainly we need more subsidized affordable housing to help meet the need among those who could not afford market rate housing even prior to COVID. All right. So we're going to dive a lot more into demographics and with the guru himself, Chris Porter. But first, we're going to jump into rental housing trivia. So today's question is, true or false, Gen Z workers are earning higher inflation-adjusted incomes than prior generations? So simple question, true or false. Obviously, this one affects apartment and SFR affordability for the future as well. So true or false, cast your vote, and we'll get to that answer in a bit. Next up in the news. All right, we got some big headlines this week. The first one came right before actually, now it's a little bit old. I should have covered this last week, but it's FTC eyes probe of large single-family rental owners. This is from Biz Now, but it got covered elsewhere too, of course. It came just days before the inauguration of President Trump. Let me read a little bit from this article. It says, the FTC issued a request for public comment seeking input on how to probe single-family rental owner-operators' impacts on the housing market. Now, let me stop right there. This very first sentence, I think, should probably bother anybody who kind of philosophically opposes the idea of finding a target first before seeing a crime of any kind of sort. So that's a pretty interesting sort of approach here. Is, hey, we just want to talk. We just want to study this issue. So that's a pretty kind of loaded way to approach this, basically trying to see if there's a problem or trying to find a problem that may not even exist. And it says, the article here, the probe would target more than 30 firms that each own at least 1,000 rental units, the FTC said, although it did not name the companies. More details came from Multifamily Dive. They said this announcement comes less than 1 week before the inauguration of President Trump. In a statement alongside the FTC's announcement, Commissioner Andrew Ferguson, whom Trump has appointed to succeed Khan as FTC chair, and also fellow Republican Commissioner Melissa Holyoke, expressed their disapproval of the timing of the notice, but said the study itself is a good idea. So I went back into that letter from them, and they wrote, divorced from context, this study is a good idea. The effects of large SFRs on housing prices have been subject of bipartisan concern and of substantial public outcry. So they're basically saying here that nothing may come of this under the new administration, but it's worth opening up to public comment, and that's a good idea for a study. And, my thought to that is that, hey, if it's a study and if it's actually fact-based and not hot air-based, then certainly it's a good idea to help debunk all the boogeyman conspiracy theories out there. But as HUD Secretary nominee Scott Turner pointed out during his Senate confirmation hearings, institutional investors represent only about 2% of the single-family rental market. The reality is, people don't fully appreciate is that SFR is one of the most fragmented industries in the entire country. Okay, so I pulled some data here. If those of you can see the video, you can see this chart. I put this together using some data from John Burns, and it shows the largest 50 SFR owners combined represent less than 4% of the market. And no one single player owns more than 0.57% of the market. Okay, the largest player is Progress Residential with a whopping 0.57% of the market. I mean, I don't think anybody could think of one industry where the largest player represents less than 1% of the market. And so that's a really important fact that we just don't talk about enough as it relates to this topic. SFR is dominated by mom and pops. And furthermore, we're actually losing SFR supply, not gaining supply. So it's really curious that the narrative hasn't really caught up to the facts. Harvard Joint Center for Housing Studies, among others, have pointed out that we've seen more SFR converted owner-occupied units in recent years than what we've added to SFR supply. A lot of owners, I've talked about this previously, but a lot of investors have been moved to the sidelines over the last 5-10 years, instead focusing more on, in terms of buying scattered site and individual homes off the MLS, and instead focusing more on growth through BTR construction and through SFR portfolio acquisition. So bottom line, there's a lot of silliness here, and it comes from both parties. I mean, I mentioned this previously, but even Vice President Vance, when he was still a senator, he made us think about this issue as well, and did not have all the facts in some of his comments. So hopefully, best case scenario is the FTC can look into this and do some myth busting to shoot down the wild conspiracy theories that many people just lazily accept as fact. So fingers crossed. All right, more SFR news. This one from Bloomberg. Brookfield nears $950 million purchase of Divvy Homes. We'll read a little from the article here. It says Brookfield Asset Management is nearing a deal to buy 3,800 single-family rentals for about $950 million through an acquisition of startup Divvy Homes. About 65% of the homes are in markets such as Atlanta, Dallas, and Tampa. After the acquisition, Brookfield's Maymont Homes division will oversee about 20,000 properties combined. Divvy was founded by Chief Executive Adina Hefetz, I apologize if I mispronounced that, in 2017 with a rent-to-own model. So this is a rent-to-own business. The company acquired homes on behalf of its customers who then rented the properties with a contractual option to buy the house in the future. So, just brief comment here, this is a good reminder that rent-to-own is just a wonderful concept in theory. I mean, it checks so many boxes. I think it's a good thing. It could potentially be a good thing for home buyers who couldn't otherwise buy. Could be a good return for an investor if it makes sense. Could really be a win-win, but it's just so far proven to be an exceptionally difficult model to execute and scale. So I'd love to see someone do it, but it's tough. It is tough. All right, next one. This one comes from National Multifamily Housing Council. It's their quarterly survey of apartment conditions. Headline here is apartment market experiences loosening conditions, but also decreased deal flow and less availability, financing availability to start the new year. So I put a chart together here showing the survey results and a little headline here. I'd also wrote about this on LinkedIn and X. As interest rates go up, apartment investor sentiment goes down. And so what's really interesting is you go back to the survey in October, and it showed some of the best optimism in 2-3 years. More equity financing availability, more debt financing availability, more expectations for sales volume pickup. And what a difference 3 months makes. All right. So, now we're seeing a big drop off in respondents' answers on equity financing availability, even a bigger response drop off in debt financing availability, and a substantial drop off on the sales volume outlook as well. So, what really changed? It wasn't supply and demand or economy or anything else like that. It was obviously rates. Back in September, rates dropped below 4%. The yields of the 10-year Treasury dropped below 4%. And today, we're back in the mid-upper 4s. And so that obviously makes a big difference. We see over and over again, this is a little bit of a controversial topic, but Peter Linneman did a great study years ago showing that interest rates and cap rates are not well correlated, but obviously does impact deal flow, right? It means there's just fewer deals are going to pencil out. So we're not seeing this mass discount associated with higher interest rates, but we're also potentially now see even a longer freeze in the sales market. So in the apartment sales market. So we'll see how this plays out, and if the rebound on sales may be a little bit delayed. And last headline, this one comes from the Bipartisan Policy Center, and it's a really good idea. So I'll read a little bit from this. It says the J. Ronald Terwilliger Center for Housing Policy partnered with Novogradac, who produced a report offering design recommendations for a pilot renter tax credit program to help working families secure rental housing in neighborhoods with good schools and jobs. Property owners who rent to households with at least one essential worker, such as a law enforcement officer, firefighter, or teacher, earning at or below 80% of the area median income would be eligible to receive a tax credit in exchange for charging affordable rents. Novogradac estimates a 4-year pilot program of $500 million per year could assist approximately 53,000 renter households in urban and rural areas nationwide. So I love it. Obviously a lot of specifics here that have to be worked out. And I would need to dive into more of it, but conceptually, I love this idea. I love seeing win-win concepts like this. So much of the landscape these days is all about this tug of war between one side or another, favoring one or the other, when we really should be focusing on wins, mutual wins for all sides. Something like this is beneficial to communities and to renters and to investors. The more we incentivize investors in ways that are in the public good, the more investors want to be part of that solution. So I hope this concept has some legs, and congrats to the team over at Novogradac and the J. Ronald Terwilliger Center for this proposal. Let's get back to rental housing trivia. This week's question was, true or false, Gen Z workers are earning higher inflation-adjusted incomes than prior generations? And the answer is true. Most people just looking at headlines probably wouldn't know this, but it is true. And here's a good data point from John Burns. We're sharing a lot of John Burns data today and having someone from John Burns on the show today. Someone born in 2000, so someone 24, 25 years old, is already earning more than prior generations did. And it's the same of millennials as well. Someone born in 1990 is earning more than $60,000 today, which is well above prior generations, even when adjusted for inflation. So that's another good sign for growth, for the demand funnel, and for long-term affordability. All right, so that's going to lead us right into this week's interview with our special guest, Chris Porter, a longtime demographer of housing, guy who wrote the book on this topic, and a senior vice president at John Burns Research and Consulting. All right, now we got the interview portion of today's podcast, and I am really excited to welcome in my friend, Chris Porter, Senior Vice President at John Burns Research and Consulting, and a guy who, along with John, literally wrote the book on housing demographics. So, Chris, thanks for being here.
Well, thanks, Jay. It's a pleasure.
So, as I referenced, you did truly write the book on this. You and John wrote, I can't believe I remember getting this book on my desk, John mailed me a copy. And I had to look back. It was almost 10 years ago. I think it was 2016, right? It got published.
That's right.
So it was called Big Shifts Ahead. And y'all really broke down demographics, especially as it relates to housing, in a way that hadn't been done before. And obviously, it's been a while. We won't cover all the details. But as you look, I just want to ask you kind of big picture. As you and John, as you look back at what y'all wrote, what has played out over this last decade as you expected? And what maybe hasn't played out as you thought it would?
Yeah, no, that's a great question. And just, I want to do a little bit of a callback to your previous episode. I was listening to it with Steve Kimmelman, and he was talking about when they look at a piece of land, what are the three things they look at? Its population, its households, and its income, and those are all demographics related. So we know demographics drives housing. There is a pattern that you can follow of somebody's housing choices over their lifetime. But we were really interested in understanding, how do those patterns change over time, and what are the reasons that those change? So wrote a book on different frameworks you can use to look at the demographics picture. I think the big one that we got was the suburban growth. We said, based on the aging of the population, you have all these 20-somethings moving out of the cities and going to the suburbs as they form households and have kids. We certainly saw that accelerated during the pandemic, but we did say, look, the suburbs are going to capture the outsized share of growth. Not that cities are dead, not that rural is truly dead, but it's the suburbs is the story of this next decade, and that played out just as we expected, maybe even a little bit more so.
Yeah. And by the way, just to give you a kind of a further pat in the back here, it's like for people who don't remember back that long, back in the mid 2010s, it was all about, hey, millennials just want to live in the cities. I remember one guy said on stage at a conference, I've told the story a bunch of times, he said that millennials would rather drink battery acid than live in the suburbs, and so it sounds easy to say this now, but this wasn't a mainstream way of thinking 10 years ago.
And I think part of the challenge is just how do you define suburban and how do you define urban? That was and how do you define a millennial? I mean, that was part of the problem at the time was, we were having conversations about somebody born in 1980 and somebody born in the year 2000.
Yeah.
Depending on which definition of millennial you use, they might still both be called millennials, yet they're in very different stages of life. And look, it's a natural fact that, despite the fact you say, I'm never going to move to the suburbs, you probably move to the suburbs at some point. And so we just said, let's get on the common ground and establish some terms and definitions that you can agree with or disagree with, but at least we've set the baseline there. And so we can make our forecasts off of that. And, these are big picture forecasts. There are obviously things that can change those. And I can talk about sort of one of our misses there and how that
tell me
changed
about that.
and why that changed. But, I like the fact that we've got this long-term outlook that's somewhat predictable with demographics, and then we take our best guess on the things that are not as predictable, but use data to back that up.
Mm-hmm. So looking back on it, what's one thing that, if any, that you missed on or just didn't play out as you expected quite as much?
So at the time that we were writing the book, homeownership was declining in the U.S. And, I'm trying to remember exactly where it was at the time we wrote it, probably close to 63%, 64% were coming out of the great financial crisis. We had seen homeownership declining, one out of financial necessity, people who just maybe it got foreclosed on and had to move out of an owned home into a rental home. But at the same time, we're also seeing a shift in consumer sentiment. And this was something that we had, one of the reasons we had dug into the demographic data, we sensed something had changed with the consumer during that period of time. And we were seeing more acceptance of renting, especially amongst older adults.
Yeah.
Maybe that again was forced on some of them, but they liked the idea of this lock and leave lifestyle. And so we were seeing a real increase in rentership rates amongst older adults at the time. And so, based on what was going on at the time, based on what we saw that shift in preference, we called for homeownership to continue to decline. And I think we said about 61% by 2025. Now, who would have thought we'd go down to sub 3% mortgage rates?
Yeah.
And, Dodd-Frank loosened up a bit. So there were certainly some factors, and we laid out all of our assumptions. But there were some factors that came at play, and we talk about the four big influencers of the demographic shifts. It's the government, the economy, technology, and these societal shifts. And we saw those come into play, and that's why rentership decreased, homeownership increased. And so that's maybe the one area where I think we kind of missed the mark there.
Yeah, and again, just to give you some credit here, I think everybody was surprised by that, and kind of a bad timing too, because I think that's right around the time that homeownership actually bottomed out, and then everything started to kind of loosen up a little bit. All right, so let's shift gears to the current state. And so I want to dive more deeper into some of these data points as we get into this, but just at a high level, what are some of the headline trends and demographics that you're seeing right now, and especially as they relate to housing and more specifically to rental housing demand?
Yeah, well, I think obviously population growth and household growth is a big one right now.
Mm-hmm.
And I think a big part of that is around the immigration issue. We won't get too political here, but we did see the surge in immigration over the last couple of years, which has contributed to much stronger population growth in the U.S. than we were going to have otherwise. And that's also aided our labor force as well. So we've seen stronger job numbers, I think, as a result of that immigration. Our team, demographics team, Zach Ray and Eric Finnegan, did some great analysis where they looked at the impact of how much increase in rental housing have we seen as a result of increased immigration, and it really has gone towards the rental space more so than the ownership space. So it's that's something that's been obviously top of the news in the last couple of years, and there's obviously some policy changes in place right now that could slow that rate of growth. And so we're keeping our eyes on that for sure. That's a big one for us.
Yeah, so let's dive in a little more because I get I'm sure you do too, Chris. I get this question all the time related to immigration. You follow this stuff more than me, but on the one side, it's clearly people coming into the United States. A lot of them are start off as renters, there's no doubt about that. But on the other side, when I talk to kind of institutional apartment SFR owners, publicly traded REITs, or kind of your Class A and B owners, they don't see immigration, at least recent immigration, as a real factor in their and who's signing leases. And so I wonder how much that's, and it's obviously difficult to track this, but how much of that is really ending up in the kind of shadow market rental pool, kind of substandard or basement apartments, coupled up households that are living in a shared rental unit, maybe not even on the lease. Do you have any kind of sense of kind of how that might be playing out?
I don't have any quantifiable numbers around that, but I think you're right. I think we're not necessarily seeing it in the institutional space in the same way that you're seeing in some of the other classes of apartments. So I think you're right.
And then moving on from that too, as we look forward, because of that, like, again, it's really kind of a sub-institutional space. And again, I don't want to get political, don't want to upset anybody here, but if there is, impact in kind of immigration policy in the U.S., I mean, how big of a factor do you think that would be in kind of the more traditional institutional level rental housing demand?
Yeah, I think again, as we kind of look at possible slowing in immigration, we've already seen slower numbers come in, but if this were to continue, I do think it impacts the rental space more. And again, I think more of it is going to be in those other classes of apartments, not as much impact on the institutional side of it as you would see in some other classes.
Yeah, I guess the only real risk is a bit more to institutional space is if there's a broader economic slowdown associated with immigration policy. But that's a people smarter than me can figure that one out.
Correct.
All right. So also related, related on population side and demand side, your colleague Eric put out a great chart recently on young adults living at home with mom and dad, and it showed 800,000 young adults between the ages of 25 and 34 left the nest between 21 and 2024. And most likely became renters. And then the share of young adults from 25 to 34 living with parents dropped from 18 to 16%, which doesn't sound like a lot, but it actually certainly is in terms of total numbers. So, Chris, what do you make of that trend, and how big of a factor do you think it is in terms of apartment and SFR demand?
Yeah, so what we've seen over the last few years is obviously more and more young adults moving in with parents during the pandemic era, and a little bit slower to leave. I think it got up to about 18% of 25 to 34-year-olds were living with their parents at one point. Now, we go back and look at this historically, I think the long-term average is about 11%, but really it's been rising ever since the GFC era. Just as we went through recession in this country, more and more young adults lived with mom and dad. I also think the parents were more okay with that than maybe prior generations had been. You see a lot of close connections between young adults today and their parents. And it's just kind of more accepted. So we're now back down at I think 16% is the latest number of 25 to 34-year-olds, back where we were just prior to the pandemic. So it is a shift in a different direction than from where we had been going, but we're not back to that 11% rate anytime soon. I don't think we get there anytime soon either.
Yeah.
But you're right. It's a movement. It's a positive growth in terms of the impacts for rentals. And I think we did see a boost to both probably the apartment and single family rental space. I think probably the closer they are to 34 probably impacts single family rental more. The closer they are to 25, it's more likely to impact the apartment space.
I agree. So, it's just kind of going on this trend further. When this topic is covered by the media, it's always about, I shouldn't say always, like it feels like it's often kind of framed as people can't afford anything, they have to live with mom and dad. But we also see these other kind of broader trends around people are just, there's different terms depending on how cynical you want to be about it. Delayed adulthood, prolonged adolescence, people taking longer to get married and have kids. And for renters in particular, the way I kind of see this, I'll run this by you, is it feels like for whatever reason, the renting stage of life has elongated. And so you talk all the time, it's like, hey, people don't want to be, not ever going to be homeowners. I don't really see it that way. I think more just like they're in that for various reasons. We know that they're in that stage of life longer. Typically marriage and kids is a reason to move to single family home, go buy a house. So if you're waiting longer to do that, you're going to be in a renting stage of life longer, which kind of plays out in terms of more demand, even if the population size doesn't change. Is that a fair assessment?
No, I think it is. And you go back and look at this, let's go back 100 years. Young adults used to live with their parents until they got married, right?
Yeah.
That was but now they were getting married at 20 and 21 back then.
Yeah.
But that was more common for young adults to continue to live with their parents. We talked about this in our book. It was really that group born in the 1950s who kind of changed the game, and they said, we're moving out. And they did move out like nobody else had it prior. And with each subsequent generation, we started to see more and more of that. More independence at a young age. And now we've kind of gone back to a little bit more of that sort of old style of living with your parents a little bit longer. And part of that is financially driven. Some of it is just, it's smart. If you want to save up for a down payment and skip the renting phase altogether. I mean, I know some people are doing that. But also I think there's also a piece of it that is people just wanting to rent something a little bit nicer than maybe they could at 22. If you can live with mom and dad for a year or two, maybe you can rent something a little bit nicer. The other thing that I think maybe has been a bit of a game changer, and we've talked for years about this coming transfer of wealth between the generations. And, when the boomers, who are probably the wealthiest generation ever, begin to pass away in bigger numbers, they're going to bequeath their estate to their kids, and that's going to help them with their housing. I don't think they're waiting until they pass away. I think we're seeing more and more of that wealth transfer happening in real time. It's give while you live. And, these parents who maybe had fewer kids than prior generations, and they want their kids to be safe, they want them to be in great housing, are helping them out. We did a survey of Gen Z this last year, and we asked, are you getting any assistance with your housing costs? And we asked this of both renters and of owners. Assistance from family members. 42% of renters and 40% of owners in the Gen Z age group said, yes, I'm getting some sort of assistance from my parents on a monthly basis.
Wow.
Now, whether, or maybe not a monthly basis, but overall, it could be help with a monthly bill, or it could be, as much as a down payment on a house. And so we didn't really stratify those particular categories, but they are getting, actually, I think we did, but they are getting some assistance from family members.
Yeah, no, that's a great point. And certainly what's interesting, I think in the rental housing data we've seen is we've not seen a big spike in co-signers, but it does feel like there's more kind of assistance provided other ways that maybe doesn't show in the sign of a co-signer. But Chris, let me ask you another question too, though. It's being a little more cynical. Obviously, people are saving money, living with mom and dad. Some of it's lifestyle driven. But let's be honest. There's also those numbers are higher for the guys, and there's a gamer generation factor in here as well.
For sure. The other thing too, I think just even some attitudes about family and marriage has changed the game as well. There's this great survey. It's a consortium of different universities, and they ask 12th graders every single year about what are your attitudes about family and about marriage. And we've seen a noticeable shift really in the last decade or so. Now, is asking a 12th grader about their future, the right way to approach this? I don't know. But I mean, historically, the numbers were pretty flat, but we've seen a real uptick in this last decade. And you could tie it to, I don't know, video gaming. You could tie it to cell phone usage. I'm sure there's a number of different things. Social media. It's a marked increase in the number of people who say, or number of 12th graders who are saying, I probably might not have kids. Now, it's still a minority percentage. I think it's 12% saying I won't have kids versus 6% historically. And on the other side, on the marriage side, we've seen a slowdown in the number of people saying, being married is the ultimate goal for me. Still, the majority aspire to that. But it is a marked change from the long-term historical average, which has been pretty flat in really this last 10 years or so. So maybe there's a component of that as well that's playing into this.
Yeah, it's a change in aspirations. But yeah, I don't know that. I'd be afraid to know what I would have said as a 12th grader. I'm not sure it would have played out. But yeah, I'm sure there's certainly still some correlation between how this is playing out. So let me ask a related question, Chris. We'll talk about household sizes. And so one of the things and I most closely follow the rental housing side. I don't know the homeownership side as much, but one of the things that's been really interesting, and again, just looking at what's been publicly reported among REITs and other institutional SFR apartment owners is we saw this big shift after or during the pandemic to see smaller household sizes. You work from home, got tired of the roommate, whatever situation, and we saw in terms of adult lease signers per unit, those numbers started to go down a little bit. And everyone's been waiting to see, okay, rents jumped in 21, 22. They've been flat since then, but they've had, obviously saw some rent acceleration. And everybody's kind of looking for, okay, when are we going to start to see more doubling up? And at least in the institutional space, in the REIT world, we're still just aren't seeing that. But I'm curious at a kind of broader level, what are you seeing in terms of household sizes right now?
Yeah, if you go back and look at this, the long term, adults per household in the U.S., and I'm not talking about just renters or owners, but just talking about all households, it's been pretty flat around two, hovering, plus or minus two for decades. And I do think that there's some changes going on there, though. I think it used to be more couples. That's how you get to your two. Now it's a mix of more singles and of what we're just talking about. Maybe it's the adult child living with their parents, and you get a household of three adults. So I do think that there's a shift in the makeup of those two-person or the average two-person households, and maybe it's the one-person households that are renting the apartments, and it's the three-person households that are still in single-family owned households. So I it's interesting to kind of look at this long-term trend and see, okay, it all still hovers around two, but I think it hovers around two for different reasons right now.
Yeah. Yeah. There was a great, I think people who, I mean, obviously, this, Chris, a lot of people have really, I used to get a lot of questions saying, hey, how is there so much, demand if there's not population growth? And there was a great paper written a couple of years ago about New York City, and it was showing that even though the city lost population, there was an increase in number of apartment renting house, or maybe I don't remember, households or whatever, because of this phenomenon. You had decoupling roommates at the higher income levels who are now all of a sudden, vacancy was going down even as population wasn't growing. Because of that phenomenon. And I think the largest of that's burned off, but it's an interesting sort of factor that, sometimes the housing doomers are making it all about population, but it's just not quite that simple, right? Population, household sizes, and the formation.
You're exactly right. And I think it's important to look at the age of the population as well. It's not just how is our overall population growing, but are we growing adults? Are we growing households in the, 25 to or population in the 25 to 54 age range? I mean, all of our growth over this next decade, as we sort of age our population, we're going to see growth in the 70 plus category. That's where the majority of the growth is going to be. And it's people aging into the 25 to 54-year-old group. It's that empty nester group, which I'm going to be aging into here over the next decade.
That's scary.
That 54 to 65 or 54 to 70, it's the group that's going to be shrinking because there's just fewer of us born. And compared to the prior generation.
All right, so let's talk about that more, because that's a big topic, right, for housing and particularly rental housing. So what's interesting to me is I look at, you may have better sources. I looked at recently the Oxford Economics population forecast, and they show nationally over the next decade we're going to be down slightly in the 25 to 34-year-old, or sorry, 20 to 34-year-old population, which is particularly important for apartments. Not a big number, but modest decline, less than 1 million. But it's obviously not evenly distributed. They still are showing pretty substantial growth in young adults for places like Texas, Florida, the Carolinas, Tennessee, Arizona, Colorado, Utah, these kind of places. So so let's just start with that young adult group first. Kind of what are your thoughts on the kind of the core apartment demographic and what because for those of you who maybe aren't familiar with the trends, I mean, obviously, Chris, this is like we went through a period where we just saw phenomenal growth in the number of young adults, and now that big bump is sort of moving out. So how do you see this playing out over the next decade?
Well, I think there's two things we need to keep in mind here. One is, even if it's growing at a slower pace, it's still growing, and secondly, these are still big numbers that we're talking about. I mean, we're talking about tens of millions of people. Think about it. There's basically about 4 million people born every single year. So even if the growth is a little bit slower or even falling, it's not falling by as much. And these are still really big numbers that we're talking about. We're not falling off a cliff by any means. As we kind of look at and I'm just glancing over at my chart here, I think you're right. We're seeing a little bit slower growth in the 20 to 34-year-olds. And we've done our assumptions about what's happening with immigration. We know that, a lot of people tend to move to the U.S. in their 20s and their 30s. So that's going to fuel some of that growth. And you can argue all day long about what that forecast looks like for immigration. But yeah, we're probably seeing a little bit stronger growth, and this again just based on the aging of the population, in people in their late 30s to mid, I would say late 40s, and it's because that's the group that's had more births in the U.S. During that period of time, and they're aging into those age groups. And the same thing is happening on the other end of the age spectrum. That 70 plus group is growing tremendously over this next decade because it's the group that was in their 60 plus that was growing over this last decade. So
Yeah.
I think it's really important to keep an eye on sort of what's happening with those different age segments. And that really is going to impact not just your overall population growth, but it really does impact those specific targets if you're looking at just young adults for apartments or, seniors for senior housing.
Yeah. What about the single family side? I mean, it's kind of in the middle of those two, typically, mid 30s to mid 50s, I guess, is your kind of key demand groups there. What do you think we'll see there for both renters and owners? Yeah.
We see a little bit of a pickup in that 35 to 50 age group compared to where we were these last 10 years. Again, it's the aging of the population. But increasingly, we're seeing more of that group or a sizable amount of that group still renting, and maybe they're renting single family, maybe they're renting build to rent. And I think that has been a great a stepping stone for many of these groups as they're moving from renting apartments and they're not yet ready to buy a home. The single family rental or the build to rent makes a lot of sense for them. And I think that's filled sort of a demographic need.
Yeah, I want to get more into BTR in a second, but before we do, what about one of the things I think has been a real positive is senior housing is an interesting topic because we've probably seen at kind of a macro level, there's not been as much demand as kind of it's not been bad, but it's not been as much demand as some of people thought, just by the pure aging demographics. But instead, we've seen a lot of, or I should say at least a pretty sizable chunk of older adults who are choosing to rent more conventional rentals. Sometimes it's seasonal, gonna get an apartment near the grandkids. And so even with, the younger adult demographic population growth slowing down a little bit, we could still see some apartment SFR demand driven by people in that 70 plus crowd.
I think you're exactly right. And I think, for some folks, as they're downsizing, the idea of the maintenance-free lifestyle really does appeal to them. And, maybe an apartment doesn't necessarily provide the same amount of space for them to show off all their stuff, they've accumulated over the years. And yes, they want to downsize. But I think the single family rental or build to rent has been a great opportunity for them. And we've seen that some survey work that we've done is shown that build to rent, especially, it's a great opportunity for people who are in transition, whether they're moving to a new area and just kind of want to test it out, get a feel for where they ultimately would like to settle down. Maybe in many cases, it was people waiting for their home to be built and they already moved because they wanted to be close to the kids and the grandkids like you're talking about. And we're just waiting for their home to be built. People going through the loss of a spouse or maybe going through divorce, they're in a transition stage in their life. And I think we've seen demand or derive out of that. It's a big topic in our research on this space.
Yeah, I love it. And y'all have really been at the cutting edge of this. You put out some really good surveys on BTR renters, kind of their preferences. You mentioned maintenance-free living. I think that's one thing that, sometimes those of us who are more, and I hate to sort of put us in this category now because it feels like we're older to say it, like middle-aged people, like we don't really fully appreciate those who are these surveys that show people like the maintenance-free living, how big of a deal that is, but it really jumps out in these surveys. But also I think it's really important as you mentioned this stuff because there's this kind of mindset in the headlines right now and some of the policy discussions that BTR is some kind of replacement for homeownership. And I think I like the way you said it. It's really more of I think it's filling an unmet need, a niche in the market that's not for everybody, but it is a certain niche. And I like that word you use, transitional stage of life for people who, for whatever reason, they don't fit an apartment and they're not ready or able to buy a house that particular time. Is that fair?
Yeah, I don't think that's, the story for everybody, but I think that is a niche that's certainly being filled by this BTR offering.
Yeah. Yeah. And again, not for everybody. And I think that's the hard time. It's hard to have a conversation with folks. So like, I don't relate to that. Well, That doesn't mean it doesn't exist. There's a niche for it for
Sure.
certain types of people. And also too, I think a lot of people don't appreciate, and your group again does a great job tracking this, is it's still such a small part of the housing market. I mean, we're talking what, a few 100,000 units across the country. It's just it really is a niche right now, one that I think we're in the early innings of.
And then we talk about the single family, scattered single family rental. I think it gets lost in some of the numbers, but I mean, single family rental is a third of all rental properties across the country. Still apartments, dwarf that, or apartments overshadow that. But it's a third of renters across the country are single family renters. Now it's a lot of mom and pops. That's the overwhelming majority of the owners there. The institutional space is still pretty small overall in terms of single family rentals. But that again is also for a long time filled a niche in the U.S. housing market.
Yeah, no, that's a great point. So I guess one last question on that then is, as you think about kind of apartments versus BTR versus scatter site SFR, what are the key differences and kind of your core demographics between those three groups?
Yeah, I think we've seen we've got a great chart in one of our reports. I can send that to you that kind of looks at the apartments versus single family rental, and it's more the scattered site single family rental. And then we've got some survey work on BTR, but it's stuff, and I think a lot of your audience probably knows as well. It tends to be single family rental. You're more likely to have kids, right? It's more likely to be married, and it's more in that age group that I find myself in right now of people with young kids and want to be in a great school district. You do see more singles in apartments. Incomes tend to be higher with the single family rental. And then if you layer on top of that, the build to rent, these are some pretty strong incomes that we see in these build to rent communities. So
yeah, they really are.
There is you can certainly, there's a lot of overlap. I think it's also really possible to sort of see some of those big differences between the different groups.
Yeah, that's such a great point. And on the income side, that's one of kind of my pet peeves in the research space, is that people want to sort of superimpose the census renter income data on all forms of rentals, but these institutional grade rental housing, which includes BTR, by the way, and a lot of Class A, B apartments, like this is a demographic that's bringing in incomes well above census median renter income household data trends.
Yeah, that's a great point.
All right. So, Chris, I want to ask one more question that's more of a kind of in the weeds question, but something I think bothers a lot of people sometimes. I'll get questions at events and whatnot saying, hey, we'll pick on Miami, for instance. A few years ago, everyone's moved to Miami, corporate relocations to Miami, but the census is showing negative migration or negative population, whatever it may be. And so, if you have thoughts on Miami, that's great. I want to hear it. But more just on a broader question, as somebody who lives and breathes this data and understands it, when you see a data point from population or migration that doesn't make sense, what do you do to sort of fact check that or evaluate it? How do you cross-reference it, to kind of see how real that data point might be?
Yeah, it's a great point. And there's a lot of confusion around this. And I think even just when you look at the migration component of it, you can break it down to domestic migration, so people moving around within the U.S., and then there's the international component as well. And we've seen a number of these gateway cities in the U.S. where it looks like they're losing people to other parts of the country, but then when you layer on top the international piece, it's a different story. And so when we get that kind of data, and we always have to gut check. I kind of joke that it used to be the case that there was never enough data. And that was our job, was to find the data. And now the challenge is we have to take all the data that's available. There's too much of it, and we have to make sense of it for our clients. And so you're right. It become a game of trying to make sense of what's good and what's bad. You can get the government data. There's a lot of great providers out there that are tracking some of this. One of the things we've relied on is change of address information. So we've got a data provider that helps us understand when somebody moves, they file a change of address card with the Postal Service. And there's other forms of change of address as well, not just the Postal Service. So we're tracking that and using that to kind of gut check some of our assumptions. Now, that's good for helping with the domestic piece of it. The international component's a little bit more challenging, and there's a lot of different ways to look at that. But you're right. I think you can see some of these trends pop up in the news saying, well, Miami's losing people. But when you look at it, what's growing, it's maybe the areas around Miami. And we've seen this, and I was giving you some examples earlier of Orlando and Salt Lake City and Denver, and you look at the data and it's raw form, and you say, well, the Denver metro area is losing people to migration, or Salt Lake is losing people to migration, Orlando is losing people to migration. Well, where are they going? It's not that they're necessarily moving all the way across the country. They're going to Greeley or Fort Collins in the Denver area. They're going to Provo in the Salt Lake area. They're going to Lakeland around Orlando. So I think part of that is affordability driven. Part of it is here's the new path of growth. In some of these areas that are built out, the next path of growth is the next metro over. And so I think that's important to kind of keep the bigger picture a little bit more holistic in understanding where exactly are these people going, because it may not be, like I said, moving thousands of miles away. They might just be going over the county line to the next metro area.
That's such a great point. Appreciate you bringing some color on that. All right. So one last question for this time. I want to put you on the hot seat for a second. So
Sure.
as you're talking to your clients about development, housing development, where to go, apartments and BTR in particular, but just more broadly, if you're looking at making bets over the next decade in terms of markets, they're going to grow in particularly the core renter demographic, apartments and BTR, SFR. What markets would, in terms of just raw demand drivers, would you feel more bullish on right now?
Yeah, I mean, I think we look at these long-term trends, we look at the short-term trends, and you want to follow where people are going,
Yes.
where jobs going, and so we continue to see migration into the southern U.S., and I think it's slowed a bit, and part of that migration slowing is due to the fact that interest rates have been as high as they have, and people who own homes are moving less. But I also think people in apartments or in rentals are probably staying longer in their units. So I'm bullish on the south of the U.S. Obviously, there's some issues with insurance costs now in a number of markets that might be affecting people's decisions to move. But I think over the long term, I think your Texas markets are going through a bit of a challenge right now. We've had a lot of overbuilding and a lot of extra construction going on in the multifamily space in a number of markets over the last several years. I think that'll even out over time. I think the South will still continue to be a draw. So I'm some of these gateway city, or not the gateway cities, but the passive growth we've seen over the last few years. Yes, they're becoming more expensive, but I still think there's strong demand in markets like the Carolinas, in Nashville. I think Texas will be fine over the long term.
Yeah, there's still, they got more expensive. They're still so much cheaper than,
Yep.
you live in Southern California. You still see people, the discount to live in Texas versus Southern California is obviously still very significant. And I love their point too on the South. Like I get so frustrated. I see these, people talk about, hey, no one's moving to Austin anymore. It's like, no, guys, like it's not 2021, 22 anymore, but people are still moving to Austin. Austin's going to be fine. They're just building a lot of stuff, and that's going to take some time to work through. So I appreciate you, kind of putting some common sense around that.
But I think there's also some markets that are not necessarily in the South that are gonna do okay as
Yeah.
well. And I think there are some. I grew up in the Midwest. I think there's some Midwest markets that are, looking like pretty great deals right now. And so I think there's some opportunities. I think we just got to find a way to get more jobs to some of these markets. And we see that path of growth moving from the Midwest and the Northeast as people have. The population is older there. They're moving south for warmer weather. I'm optimistic that we could see some continued growth in some of those areas, Midwest and Northeast, if we can get the jobs there.
Oh yeah, absolutely. And I'll have another episode come up on this later on the Midwest in particular, but we're seeing more and more institutional interest in places like Columbus, Indianapolis, Kansas City, and strong growth in some smaller markets, like Grand Rapids, Des Moines, some other places like that. So I'm with you. I think the Midwest is of increasing interest both for households as well as for investors and developers as well.
It's a great place to live. I grew up right outside of Grand Rapids, and
I
wouldn't trade that for the world. It was a great place to grow up.
That is like the boom spot these days for the Midwest. So those of us who are outside of Midwest most of us don't even know where it is. But yeah, if you know Grand Rapids, that place is on fire. So, all right. Well, Chris, it's been an absolute pleasure to talk shop with you. Appreciate your insights and color and commentary and all the gems you've dropped with us here. So thanks so much for your time.
Thanks, Jay.
And that's a wrap on episode 19. Big thanks again to Chris for joining us. Thank you to all of you for making this part of your day. And join us next week. We're talking about the case for the Midwest, looking at the latest data on multifamily and SFR in the Midwest and the investment case for those markets. So we'll see you then.